Welcome back, everyone. I'm sure today's video will probably be filed under the category of more relevant than the views that it gets. But I think it's probably a good topic to discuss in that the, there's a difference between risk, volatility, and loss. And most people seem to think it's one thing, and it's really not. And so this video is going to be a quick one, but it's going to discuss how the three topics are different. So as I said, I find that people often will conflate risk, loss, and volatility in whatever order you want to put them. And while they are interconnected, they're not the same thing. And they are each of them in their own way, very relevant to the game. When I say the game, I mean stocks in general and investing. So I figured I would differentiate them here and show at least how I think about them. Let's start with risk. I'm sure you all know what risk means as the word, but what about the meaning of the term? Because for me, in investing, risk is the risk of permanently losing money. And I'm talking about losses that you can't get back in the same way from the same investment. And this is not the same thing as if the share price goes down, because that can always happen, but that's not necessarily risk. Share price goes down, share price goes up. That's volatility, and I'll get to that in a second. But risk is the possibility of the share price going down before you figure out you're wrong or something changed or the fundamentals got worse. Some examples of what might constitute a risk or like a bad thing happening that would be a risk. For example, if you buy a stock and it goes bankrupt, well, that's a risk. Same thing with if you buy a stock and share price goes down massively, for example, as part A, because that's volatility. Again, I'll get to it. And then the company issues a bunch of shares at the lower price. Well, that's where the risk fits into the volatility. Now, it's very important to understand that, I mean, the way I think about it, it's not, the risk is not that the share price declines unless you are talking about opportunity cost or you were to sell at the lower price. And it's tough because share prices and different investments all have their own volatility. Some share prices move a little, some share prices move a lot, and sometimes they move a lot violently. But if nothing happens to change the fundamental story or make the thesis different, well, then the stock is just getting cheaper or more expensive. Now, that's just part of how the market works. The price change only matters if if more shares are issued or bought back, for example, on the flip side, at the different prices. Otherwise, it's just opportunity or trading and fading moves. But the fundamentals guide the long-term price. And for me, when I think about loss, I think about it more in terms of the negative outcome. So the result, if you will, from one of the prior events. So for example, if the share price goes down and then you sell lower and you're not just moving the money to a different part of the thesis, well, then that's a loss. Or if the thesis changed and you sold, okay, that we're all wrong sometimes, that's a loss. Now, if a company goes down and then issues plenty more shares at a lower price, well, it's a different kind of loss. It's a loss of upside. And to get back to your original price, you need even more of a fundamental shift. So if you're thinking, well, this all sounds like the same thing, well, okay, hopefully this example will make more sense. So we all know the story about Paladin, 1 cent to 10 bucks or whatever. But let's rewind a little and go into the prologue. So the Rick Rule story, finances Paladin at 10 cents, falls 90%. So he decides to buy a lot more. Well, the fall 90%, so stock got 90% cheaper. volatility. So they bought more. And then the meteoric rise started. And there all the issues along the way at a higher price, the share issues, the attempts to create value and do different things, well, those could be considered gains if they were issued at higher than 10 cents. Then the taking on debt, that would be a risk, risk of permanent loss of the money. And then the flip of the cycle and share price falling back under 10 cents. And so then the share issue, when they raised money recently and when they sold assets to try and cover the debt and survive, well, then that's loss. Basically, risk is being in a position where you can experience loss. And this is because share price moves don't really matter in the short term or medium term, as long as the share structure doesn't change. Because for you, the share price only matters the day you buy and the day you sell. In the middle, unless there's share buybacks, in which case lower price is better, or share issues, in which case a higher price is better, it doesn't really matter. The problem is, or the problem can be, when the share price volatility when the risk creates downside volatility, and then the thesis changes because there's a problem, because there's fundamental change, or there's some other event, and then is when the risk could be translated into loss. So that's really all I wanted to get into today. I just think that it's a very important distinction to make between risk and volatility, because in volatile and risky sectors, often they're the same type of sectors, there's an important distinction to be made between permanent loss and wild ride. And I think that understanding that difference will probably lead to some better results over time. And with that, I wish everyone a great day, and until next time.